Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be talking about using charts to hopefully assist with the timing of when to enter covered calls positions. And specifically, I wanted to talk about how the phrase buy low and sell high can have very different implications for the covered call trader. Should be a really good discussion. Before we can get into the meat of it, let me first of all say hello to everybody that's already chatting in out there in YouTube. Great to see Austin and Bob, Bush 8531, Pine Tree 64Z, Scott, Will, Kathy, Eva, everybody else. Thanks for joining us week after week. I really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this presentation, enjoy the show, but be aware that you're invited to join us in the live discussion if you'd like to be here. This is a Monday webcast series that kicked off promptly 2 Eastern time. We'd love to have you here in our live audience. And I also want to let everybody know, whether you're watching on the recording or on the in the live session, we're joined here in the live stream by my very good friend, Barb Armstrong. She's going to be hanging out in the chats, addressing any questions that I can't get to. As long as they're on track with the discussion, Barb's there to pick up slack if I can't quite reach one of those questions. So thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everybody watching. Please do follow us on X. It's a great platform, best place to connect with your favorite presenters in between the live streams. You can find Barb there on X at Barb Armstrong CS. You can find me there at Cameron May CS. But let's get into this. And of course, the very first thing that we need to do is pause to consider the risks associated with trading. It certainly applies to options trading as well. So this is important information to bear in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And finally, any investment decision you make in your self-directed account is solely your responsibility. Okay, so with that important information covered, let's get into what we're going to address in today's discussion. And as I mentioned, the phrase buy low and sell high can have quite different implications for the covered call trader who's using charts to plan and place their covered call trades. We're going to be talking specifically about those implications in just a moment. But there are a couple of things I want to do first. First of all, we're going to have a quick peek at our existing positions in our example portfolio. Then we're going to look at the markets and see what's going on with the stock market, maybe even take a peek over at the options market, but then get into the bulk of the discussion, which is why does buy low and sell high, which is sort of this time-honored phrase, how does that have a different implication for covered call traders? Yeah, we're going to be talking about maybe when to buy the stock, maybe when to sell the call. We're going to be placing another example trade in our paper money portfolio today. So let's go right to the platform and review some of these existing positions. Now, a couple that I wanted to discuss today. First was NVIDIA, which is a short put contract that we sold. If we click on the quantity, we can always see the date when this position was taken. So this was on January 13th, we sold that put. And the preference when we sell a put is for the price to remain above the strike price. That's the 110 put in this case. And you can see the price is above. It's at 117, so that sounds like it's cooperating nicely. And yet, if you look at our profit and loss since we opened the position, we're not even treading water at this point. Let me show you what's happened. And we need to talk through what a trader might need to contend with under these sorts of circumstances. So we took this position right here. This was January 13th. We just saw that. Here's our strike price. 110 is way down here. So back then, this trade felt nice and secure. Price started to rise. We were feeling better and better and better, getting further away from our short strike. And then we had this big, I believe this was the DeepSeek announcement out of China. NVIDIA got hit and dropped. And so now we find ourselves right here at about 117. So kind of feels almost disastrous. This was a bullish trade. We'd prefer for price to go up. It's actually gone down, and yet we're only down underwater a little bit, I suppose, relatively speaking. and actually still in position for maximum gain on this trade. If we're above 110 as we approach expiration, that's the 21st of February in this case, this is still almost certainly just going to expire worthless. I have to say almost certainly because even out of the money contracts at expiration can still be assigned. And out of the money contracts can really be assigned at any time. In this case, it would just be if they were to assign right now, they'd be overpaying us for the shares by about $7 per share. It's unlikely. It actually would contribute to the potential profitability of the trade if they were to do that, but we still have to just be aware that this could potentially be assigned. So what do we want to do here? The stock has gotten some bearish momentum. If that continues through expiration, we could still be down below our 110 strike. That could be in the money at expiration. In the money contracts, with rare exceptions, are assigned. Now that actually, for our trader, may not be necessarily a negative outcome, because the reality there would be, okay, we had to buy the shares at 110. We could have bought the shares back here on day one when it was trading up above 130 bucks. So in that context, at least the trader bought the shares at about a $20 discount from where it was on day one. So that might make them feel a little bit better. They could, though, be below the break-even point on this trade. If we're below 108.88 at the moment of assignment, if assignment happens, this trade would still be underwater to some extent, right? So if the trader is okay with being put the shares, there may not be any action needed. And as a matter of fact, we're still out of the money. It's still less likely that we get assigned at this point, especially if we can start to recover. Or we could just decide to close the trade. If we close the trade today, it would be unprofitable. It's still in max theoretical gain territory at the moment, but we need to get time working in our favor again here. EVA, we just have one contract on this one. Just one. So another thing that I think that EVA might be leaning toward is, well, maybe we could scale out of some positions if we had more than one contract. A trader could think about doing that. Then Brothers Goofy says, I want an example of ever call done on a stock you already own. Okay, we're going to be doing that. Good question. You can do it at the same time when you're buying a stock. Yeah. All right. Yeah. And you say, if you already own the stock, you don't know how to add the call to it. Great question. That is definitely on the agenda today. So I'm going to put a pin in that one. We'll come back to it. But with NVIDIA, I think we're going to just let this one still work. We're still above where we need to be. Yes, the stock has broken below our support area, but still above our strike, still above our break even. And if we rise, or even if we go sideways, still in position for max gain. So I'm going to let that one go. Dragon Rider says, is it a covered call? Dragon Rider, this one's not. This is a short put, but we do have a covered call right down here on Walmart. So with Walmart, we own 100 shares of Walmart. We sold the $90 call last week. Now, typically when we're selling a call, we would prefer for the stock to stay just below that strike. In this case, just below $90. Look where the stock is right now. It's 99. Oh no, the trader might get called out here. I say, oh no, kind of like disingenuously, because the trade that we took last week was actually intended as an exit for the long stock position. We sold an in the money covered call, which has a higher probability of assignment, either assignment early, which would just mean we accomplished what we wanted to do sooner, or at expiration if it's still in the money, and this one's solidly in the money. So if we go to our chart on Walmart, this is when we sold that call. We sold the $90 call as a potential exit for the stock. I have to say potential because we're not guaranteed assignment. Just because it's in the money right now doesn't mean it's going to stay there before expiration. There are even rare circumstances where even an in the money option at expiration isn't assigned. But if it is assigned, then we sell the shares at 90 bucks. We keep the premium. I believe we collected $7.90 last week on the premium. And so this line that I've drawn down here is just a visual reference point for where we sold that call. So as long as we're up here, we're in the area where we'd like to be to optimize the likelihood of getting called out. Ocean Life says, can you also show how to add a stop loss that buys the covered call back if the stock price drops dramatically? Let me see if I can fit that in today, Ocean Life. But that's what's going on with our current positions. They're actually doing just fine. We're a little bit underwater, as I mentioned, with that short put, but we'll see if time can come in and start to bail that trade out. Walmart's doing just what we would hope it would do. So let's take a look at the stock market before we go to adding new positions to this portfolio. And we're going to be adding at least one, possibly many, not many, a few. But in any case, before we do that, maybe the trader wants to get a quick peek at what's going on with stocks and what's going on with options. And as we're speaking, so here's what's been happening. For those that are watching this on the archive, maybe a week down the line, maybe a month down the line or further, just know that just recently there were new tariffs imposed on Mexico and Canada and China. And what we're seeing here is a potential reaction to that news. So for a technical trader, what does that amount to at this point? Well, we've had a great run over the last 12 months. Could this be the start of a new sell-off, an extended sell-off for the stock market? It could. It could. What does it look like on a chart? Well, let's say our technical trader looks at this and they say, well, the trend still seems to be up. We've come down for a couple of days, but appear to be even strengthening today. As we speak, we're at the top of a white candle after the overnight drop. So we haven't quite made up all the territory that was surrendered overnight or at the open for today, but we've made up a good chunk of that. And let's just say that our trader, as they're peeking out to the horizon, maybe to February, maybe we'll go out to March this time. We already have a couple that are expiring in February. Let's maybe layer in some new positions for March. So let's say our trader's looking out there to March. What do we think? Could this be a bearish reversal? Just very early indications, maybe. But let's say our trader still thinks that things look bullish, and so they still have bullish strategies on the table to be added to portfolios, such as covered calls and short puts. Today, we're just going to do a covered call. So that's sort of a backdrop for what's happening with the stock market from a technical perspective. Obviously, it's not the way that everybody's going to view it. People can have different convictions about where the markets are headed from here, but let's just say that our hypothetical trader is still bullish. All right, so that's it for stocks. What about for the options market? What kind of a market is it for options right now? Let's go have a look at the VIX. Volatility index of the S&P 500 is sometimes viewed as a general gauge for the broader pricing of options for most strikes on most stocks. Certainly not a guarantee of the pricing for every strike on every stock, but generally, when this VIX chart is higher, the implication for the option trader is that options prices are generally higher. And that's sometimes described as a seller's market. When VIX is lower than it has been recently, some traders will look at that as, well, they might recognize that options prices are generally lower, and that might be seen as more of a buyer's market. In any case, even if we see, let's say we were looking at this chart when it was really low, does that mean we can't sell covered calls at that time? Does it mean we can't sell short puts? Not necessarily. What the trader would just have to prepare themselves for at that point is the premiums probably just aren't going to be quite as high as maybe they've seen in recent weeks and months. So right now it looks like premiums generally seem to be relatively high. There have been a few times in the last 12 months when those premiums have been higher broadly, but not very many times. So yeah, we might say this looks like it could be a bit of a seller's market, which is what we're doing today. So let's do it. So the thing that I wanted to discuss today, as we move to our first example stock, is the timing of when some traders will enter into covered calls. Now, covered calls can actually be taken as just one whole position, meaning we buy the stock and we sell the call on the same day. We have a name for that. It doesn't make it special, but we call it a buy write. When we buy the stock and we write the call, write is just another term for selling a call. A buy write is done on the same day. Now, for some traders, though, their preference is to sort of break it apart. Buy the stock when they think it looks like an appropriate time to buy the stock, and then sell the call separately at a time when they think it's an appropriate time to sell the call. And for some, they'll recruit this familiar phrase, buy low and then sell high. We are buying a stock and then selling a call option. For some traders, they just sort of tweak that phrase, buy the stock low when prices are low. Maybe they think they're likely to rise. That sort of is in line with the traditional interpretation of that phrase. Buy the stock low and then sell high. But what does this sell high mean in this case? Well, what that might mean is when the trader thinks that the price has gotten a little bit high, it's been great for the ownership of the stock, but maybe it's time to turn around and go down again. That might be the time for when they sell the option. So let's look at a couple examples of the buy low side of that equation. Has anybody been following what's been going on with these energy oil stocks? ExxonMobil, really kind of taken some lumps recently. It's traded as high as up over 124 over the last 12 months, but it's made a couple of lower highs and lower lows, and it's driven it all the way back down to about 105. And in recent weeks and months, that's maybe started to show some signs of strength there. Now, does that guarantee that ExxonMobil is going to take off and go higher again? No. But for some, maybe they see this as a sign, as an indication that maybe the price, the stock is set to make another run, potentially. Now, what are some technical arguments that might be made for that case? Well, number one is it's made a couple of touches down right around that 104.5, 105 level. There's a touch right through here. There's a separate event right here, a third right here. And then just today, we sold off generally with the rest of the markets, but then we're seeing a recovery. And as we look at today's candle, what do some of you who use some not really truly advanced principles of technical analysis, but it does take a little bit greater understanding of technical analysis to recognize an intraday, a single day candle pattern like this. What might you call today's candle? Would it help if I zoomed in a little bit? What does that kind of look like? Might look like what we call a bullish hammer, meaning prices sold off during the day, reached down this low, but they've recovered and actually gotten above today's open. Yeah, that might be a signal that prices are set to rise. Well, I think the case might be made here then. If a trader thinks a stock price is going to go up, well, let's apply that old phrase, buy low. And so let's buy the shares. So I'm going to go do that. Let's buy some shares of ExxonMobil. Going to add those to our portfolio. Now, obviously, there could be other motivations for buying shares. It may be in a sector where the trader doesn't have any exposure already and they're trying to add some diversification to the portfolio. It might be a company that's gotten kind of beaten up, but they think that the fundamental health of the company behind the stock is still strong. Maybe they think it's just a phase in the economic cycle that suits energy, and they need some exposure to energy. Whatever, those motivations could certainly go outside of the technical discussion that we've just had. But in any case, when a trader thinks a stock price is low, that can be a motivation to buy those shares. So I'm going to buy 100 shares of ExxonMobil, just as that example, but I'm not going to sell the call. So let's add a 0 here to buy 100 shares. I'm going to change this to a market order for our example trade today. And let's buy those. So obviously when we enter a market order, just remember that with market orders, prices can change quickly in fast market conditions. So when we see a price up here, it's not guaranteed that we're going to buy for that price. But that can result in execution prices that can be different from the quotes displayed at order entry. And there's not a commission on this side of the trade, but there certainly can be, especially on the option side of the trade. So we're going to send that order off. Why, though, am I going to lump myself in with that category of traders who choose not to sell the call at the same time? Why didn't I do a buy right? Well, because when we sell a call, that's an obligation to potentially have to sell the shares of stock. And maybe at this moment, the trader wants their shares unencumbered by such an obligation. They don't want to be in a contract to sell the shares because they want to give that stock its opportunity to run. And if it runs up to 108, 109, 110, 111, 112, 113, we don't have some contract hanging over our heads putting a limit in the near term on how high those shares can go and how much the trader can make from any resulting appreciation in the share price. So that is just plain old buy low. That's not a huge revelation to anybody that's ever thought about buying shares low and selling high. But let's do one more. I think we're going to have time. Let's do some multiple trades. How about ABBV? This is a little bit different technical scenario. I don't know if anybody's been following AbbVie. This is a pharmaceutical company. So again, maybe there are motivations that extend beyond what we're seeing on the chart for potentially buying a stock like this. But here's what a technical trader might notice about what's happened with the chart recently. It might not look like this is low. That's the point I wanted to make. We always hear this phrase, buy low, when you might say, Cameron, it was a lot lower 2 weeks ago. True. Yep. But notice what just happened over the last 48 hours. The stock had actually been struggling below about that 182 level. That had been a previous price ceiling. It was a price floor through here. And then over the last 3 months or so, the stock had really struggled below about 182. And then an earnings announcement was enough to spur this, push it through, break through that ceiling. We got a little bit of a fade after that announcement, came back down to that gap low, or that gap high, I should say. And that looks like that's acted as a pretty good support. A previous price ceiling now acting as a new price floor. And today, it seems to have gathered some more bullish strength and momentum. It looks like we might have a bit of what we call a bullish engulfing candle here. Now, if you're not familiar with some of these technical terms I'm using, let me do you a little favor here. I'm going to put a link in the chat to a webcast series of 8 lessons that I put together, and Barb is doing a similar one right now, so she can feel free to link hers as well. It's called Getting Started with Technical Analysis, but I just created 8 lessons and took a new chart user through this process of learning about charts. I can't teach everything, even in 8 lessons, but I tried to teach as much as I can. So here's that link. Let me pop that in there. There you go. Yeah, so if you're new to charting, you want to learn more about this stuff, it's not the focus of today's discussion, but there's a link that might be useful. All right, so our trader here might say, yes, price is higher, but maybe relative to where they think it might go from here with all this momentum from the breakout, from today's big bullish candle, big bullish engulfing, maybe they think this is likely to go up to 200, maybe 205, and they don't want to put a cap on that share ownership. So I'm going to buy another stock with the plan, maybe in the future, we're going to sell a call, turning this into a covered call, but right now we're just buying the shares. So let's go to the trade tab. Let's buy 100 shares of ABBV. I'm going to put this in as a market order, but we're just putting into action the buy low part of the equation, just as an example. So with market orders, again, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. No commission on this trade, but let's send that order off. There we go. And we just bought 100 shares of, so now we have 100 shares of XOM. We have 100 shares of ABBV, and at some time in an upcoming webcast, 2 or 3 or 4 weeks from now, we may see a very different scenario on those charts, hopefully, that may present an opportunity to sell a call. So let's talk about the other side of this equation. Well, if we're just buying low for the stock, when might a trader look to sell high? And the sell high is referring again to selling the call. So here are some very different positions that we have. Here's our ABBV and our XOM. Let's right click on those and move those to our covered calls and short puts group up here. Right click. Let's do that again. There we are. But our other positions, Wells Fargo and Johnson & Johnson. Now, I added these to the portfolio as examples, okay? How about we just start with, let's start with Johnson & Johnson. Now, let's start with Wells Fargo. Let's go to that chart. So now we just need to put ourselves in the shoes of a stock owner who already owns shares. Maybe they've learned about covered calls, maybe they're comfortable with it already, but they're trying to refine when to sell the call after the shares have already been secured. When do we, and there's a terminology that we use for this, leg into that call contract. Leg in, it's kind of like a reference to how you put your pants on. Put your pants on one leg at a time, except when you're in a hurry. Yeah, you put, you can maybe buy the stock as one leg of the trade and selling the call as another leg of the trade, so we call it legging in. But let's put ourselves in the shoes of a, now I'm using too many clothing analogies. Anyway, putting ourselves in the shoes of a trader who maybe they bought the shares recently when they saw that price was low back here when it was around 70 bucks. All right. So if you'll notice, hey, what do you know? Purchase price of $70, just to sort of hammer home that point. So they bought the shares low, and what they were hoping for was for the stock to go up, which really assists in that share ownership. That's nice. That's capital appreciation. But why did my phone just ring? I always shut the notifications off. I'm going to deal with that right now before it crops up again. There we go. In any case, it's great when a stock runs up in price, but even an optimistic stock owner recognizes that most stocks don't just go straight up forever. Even if they're going higher, they'll tend to stair step. They run up and pull back, they run up and pull back, they run up and pull back. So when we get one of those run-up events like we've seen on a stock like Wells Fargo, maybe there's some profit taking that's due for the next little while. And maybe the trader thinks this might limit the upside for capital appreciation on the stock, so they could just sit there and ride that out. Maybe it pulls back for a week or two, and then it gets another tailwind, and off it goes again. But at those moments, that's also a time when some covered call traders will see this as the opportunity to sell a call contract. That can bring in some potential premium that carries with it, yes, that obligation. Maybe we have to sell the shares, but we're gonna make sure strategically we place that obligation above where the strike price is at the moment, above where the stock price is at the moment. Okay, so let's say that maybe this is our trader's vision for the next little while. I'm trying to decide whether I want to go to February. I'm going to do this for March. Let's suppose that our trader thinks that the stock is likely to pull back, give back some more of this territory that was gained. And as it makes its way toward March, maybe it doesn't get a whole lot higher than where it is right now. Can you envision that? So I'm going to enter into an example covered call, maybe up here at the $80 strike. So here's our Wells Fargo, bought it for 70 bucks. We're about to enter into a contract through the third week of March, where we're agreeing to sell the shares if we have to up there at 80 bucks. Let's go see what we might be able to get for that. So I'm going to go out here to the 21st of March and scroll on down to the $80 strike. And it looks like that's trading between 173 and 176. Maybe we can get 175 out of this, 174, something like that. So let's sort of map out our trade here. There we go. So we have our example trade, which is legging into a covered call. We already bought the shares. And so this is going to go back to that to the person that asked about, and let me maybe bold these so that they stand out a little bit more. Why did it not get the E? Let's get that too. There we go. But we bought 100 shares for 70 bucks. And now we're going to sell the 21st of March. Let's do the $80 call. And again, it's actually sagging a little bit in its value, which means probably the stock price has come down a little bit and reduced the value of these calls. So it's kind of doing what we thought it might do. Let's say we're able to get $1.72 then. And let me just make sure, looks like you're just sort of having a side discussion. Let me read your question there, Josh. Cam, I like the covered call buy right strategies. They're a simple way to identify equities with good call options premiums. For example, I looked at PFE and there's not much premium available. Yeah, Josh, what we could do, let me put that one on the list for future webcast ideas. And maybe we'll put together a search in a future webcast that looks for maybe higher priced premiums. But yeah, there are a number of different ways we might filter for that, including beta, including maybe a ratio of implied volatility to historical volatility, levels of implied volatility, I should say. In any case, here's this trade. So what are we doing here? If we sell this call, what it explicitly means is that for the next 46 days, or through the 21st of March, we're receiving a payment of basically $172, $1.72 on 100 shares. That's $172. That's what we're getting paid as a income. But in exchange for that, we're obligated. Someone else can buy our shares from us at any time between now and the 21st of March for 80 bucks per share. That's higher than the price is right now, so there's not much motivation for them to do it. But when we get into a covered call like this, they can do whatever they want. As long as we're in this contract, we have to be comfortable that the shares may be purchased from us for that $80 per share, right? So let's look at that on a chart again. Maybe what I'll do, let's put an oval around today's date. So this is when we are selling our call. And then I'm going to draw a line up here representing our strike price of 80 bucks. That's our strike. So between now and this expiration, someone has the right to buy shares from us for 80 bucks. They're not likely to do that as long as we're below 80. As we get above 80, and again, I say not likely because they still could. That just means they'd be overpaying for the shares and we'd be the beneficiaries of that. So define that as a good thing or a bad thing as you feel comfortable. But in any case, if we have what we expect, though, if price goes down and pulls back up, as long as it's below 80, we're probably still the owners of these shares at expiration. Plus, we got a little extra, $1.72. Well, what if the stock shares collapse in value? If the stock goes down, it just makes it less likely that the shares get called or the contract gets assigned, and we still keep the $1.72. It's just that as the owner of those shares, that $1.72 can sort of have be a diminishing level of comfort if we're really taking lumps on stock prices that are collapsing. So let me just illustrate that. Let me remove this drawing. Maybe let's remove that one. So if this one were to happen, let's say the stock just plummeted. Well, we still own those shares, unless somebody got a wild hair and decided to pay us 80 bucks for them anyway. We own the shares. We're taking lumps on the share ownership with $1.72 as a small consolation price. Yeah, Robert says it can go to zero. Yeah. Do we expect Wells Fargo to go to zero by March 21st, meaning the company is bankrupt, delisted, and out of thing? It's not very likely, right? But is it just inside the realm of possibility? It's there. Yeah. But this isn't unique to covered calls. This is just stock ownership reality. All right, so let's right-click on this and remove that drawing. So now, how do we add that call to the position? Here's all we need to do. Just make sure we're in the right account where we already own the stock. In this case, this is in my example account. I can go right here and see, there it is. And we just place a sell order for one contract for every 100 shares that we own for the number of covered calls that we want to do. We just go to the bid price within that account. And notice I don't have to designate this as a covered call or anything like that. As long as we're doing it in the same account, it just matches up and we're covered, okay? But let me go to that $80 call. I'm going to click on the bid price, make sure we're only selling one contract. It's the right strike price. It's the right size, call versus put. Let's see, we might be able to get $1.72 out of this. I'm going to back off of that and say we're willing to settle for $1.70. That's even below the natural. I'm trying to be generous here to try to get the order filled while the webcast is live. Still not a guarantee, though, that I get that fill. But let's click confirm and send. We're going to sell that one contract, the 21st of March, $80 call, try to get at least $1.70 for it. This is going to tell me my maximum loss is infinite. That would be true if this weren't, if we didn't own the stock already. So I'm not worried about that. But we do need to be concerned with this. Yeah, we do need to know that there's a commission here. Let's send that order off and see if we can get that filled. So Robert, you ask, yeah, you get to keep the premium. If the stock goes to zero and the other party walks and they let the contract expire worthless, yes, we get to keep the premium and feel really good about $1.72 while we lost 78 bucks or whatever on the shares, right? Yeah, but yes, you do get to keep the premium. As a matter of fact, when we sell a call, and also at the times when we're talking about selling puts, when we sell a put, we've collected that premium. Who has the right to come into our account and say, Cameron, yoink, I'm going to take that premium back? Nobody. Nope. We might choose to exit the option at some future date, but nobody can take the premium back from us. All right, so there's that trade. So we now have, if we go to Wells Fargo, you'll notice, oh, it's down here in my unallocated, and it's not in the same group with my stock position. That's okay. It's still a covered call. This is just for convenience purposes. Let's right-click here and move that to our covered calls group. Now we can see them right side by side. There's our covered call. So we have time, let's do the other one, Johnson & Johnson. So with Johnson & Johnson, let's put ourselves in this trader's shoes. Maybe they saw the stock had taken some lumps, come down to 12-month lows, but really found some pretty good support down there about the 142.5 level. So let's say our trader bought some shares at 142, bought low, but waited, hopefully, to sell high later. So with our position here, Johnson & Johnson, 142.5. Don't think that I'm just that good. I literally just added these positions today and changed the purchase price. So I don't want anybody thinking, wow, Cameron's nailing it, buying at exactly the lows. No, I just like to set up hypotheticals here so you can follow the logic. But buying low is the point. So let's say our trader bought while prices were low, and they waited for prices to run up here. And now maybe they see that we're bumping into previous price ceilings. Been a ceiling here, been a ceiling, a cluster of trading right around there, around that about 154. And it was also a support area, price floor and price ceiling. And it looks like we've just touched there again. So maybe it's been a fun ride up, but our trader is thinking, stock price may not have much more room to run up in the short term. Maybe they think it's going to pull back again, and they might see that as the opportunity to now sell high. Not meaning sell the stock and get out, but instead sell the option, collect some premium, and see if we can get that contract to expire worthless. Okay, so how about for this one? Maybe what we're going to do is let's see if we could sell the 155. I wonder what we could get for that at this moment. So that's going to be up above our resistance. I'm going to put an oval around today's date as a visual reference point for when we entered this short call. Oh, and by the way, look at this. Here's a quick side observation for those of you who maybe just learned about hammers. I just talked about hammers on one of our other trades. This looks like a hammer. It's not a hammer, at least not in my technical view. A hammer can carry that label if it appears at the bottom of a down move. If we get the same looking candle at the top of an up move, what do we call it? It has actually the exact opposite implications as a typical hammer. This, what we might call a hanging man, which sounds bad, and it's intended to be bearish. Yeah, that's a hanging man, looks exactly the same, just the top of an up move rather than the bottom of a down move. So let's go sell a call on this. Go to the trade tab. Let's go out here to 21st of March again and look at maybe that 155 level. That looks like that's trading between 189 and 197. Maybe we get a $1.90-ish for this. So again, we're collecting an income, but taking on ourselves an obligation where we might have to sell the stock at a higher price than it's trading for right now. But the trader just needs to be comfortable when we enter into a covered call contract. It's a contract that obligates us to sell our shares, maybe. We're just trying to, for these traders who are selling high, they're trying to minimize the likelihood of assignment. That's the objective there. So let's click on our bid price. Now notice Johnson & Johnson, we already own it. So all I have to do is go to the strike price we intend to sell, click on that bid price, make sure it's the right number of contracts, correct strike, correct side or type. Let's see if we can get a $1.90 out of this one. And let's confirm and send that one. Selling that 21st of March, 155 call, trying to get a $1.90 for it. That would give us a $1.90 income. Not an infinite max loss. It would be if we didn't own the shares, but we do own the shares. Credit of a $1.90 minus the 65 cents would mean if we fill a $1.90, 189.35 is sort of our minimum acceptable credit on this right now. So let's send this off and see if we can get a quick fill. There it is. Yep, sold it right at 190. Okay, but what does the trader want in both of these scenarios from here? Well, if they don't care if they have to sell the shares, if the stock rallies and they wind up having to sell the shares for 155, all right, well, they collected some income from the option, which they would then keep. They bought the shares low and then actually were required to sell the shares high. Now, it might be at a price lower than the current price at that moment, but that would be at a higher price than the original purchase price of the shares, and that would close out a profitable trade. If the stock goes down, maybe more like the trader hopes, then the contract may just expire worthless, and the income just helps us ride out a bump along the way as we're going higher. So, guys, we've actually accomplished what we set out to do today. I did notice here. Let me see. I just want to check something. Did that survey just come in? All right, cool. There's a survey. All right. So as I wrap things up, let me first of all say for the live attendees, there is a survey in the chat window right now. You can click on that survey. Give me some honest feedback when we wrap things up here in a couple of minutes. That's always appreciated. Those are super short survey, just 2 multiple choice questions, a comments box and a suggestion box. And if you fill it out, I promise I'll always take the time to read through your comments. The data from the feedback helps me just improve. So I appreciate that. Also, I want to make sure that you are familiar with some other resources you have outside of this. So let's wrap it up. We've accomplished what we set out to do today already. We took a look at the markets just to see what was going on with the S&P and with the volatility levels. We reviewed our existing positions, and then we talked through how buy low and sell high can have very different implications for a covered call trader than maybe the traditional stock interpretation. So I hope that was a useful discussion for you. We'll see how these trades go. We'll see if the stocks that we just bought, hopefully low, go higher. And we'll see with these calls that we sold while prices are hopefully high, maybe if those can sag a little bit, we'd keep those premiums without having to sell the shares. Time will tell. But with that accomplished, let me make sure that you're aware of the other resources that are available to you outside of these webcasts. Number one, make sure that you're subscribed to our Trader Talks channel. So you can go down and click on the subscribe button right down below my window right now. Trader Talks, our channel is where we host our previous webcasts in nice little tidy playlists. So you can find those right here, including the one that I linked earlier. If you're watching on the archive, if you were to click on playlists, and you see this right here, new to stock charts, start here. That's the playlist that I already linked. You can also join the live streams right there. It doesn't cost anything to subscribe on YouTube, so might as well. Just makes life more convenient for everybody. Also, make sure that you're following Barb and me on X. That is the best place to connect with your favorite presenters. It's where we can post things as they're developing rather than waiting for the next webcast to come around. So you can follow Barb there on X at Barb Armstrong CS. You can follow me there at Cameron May CS. And if you reply to one of my posts, I try to reply right back to you. It makes for great interaction with your favorite presenters that just aren't otherwise available except when the camera is rolling. I also want to thank everybody who's already clicked on that like button. So I can see we have 142 people watching. We have 46 people that have already clicked that thumbs up. That is very much appreciated. To your presenters, it feels like applause. It feels like a pat on the back. It also gives my webcast a boost in the YouTube algorithm. It helps it find a wider audience and help more people, hopefully. So always make a habit, if you enjoy one of our webcasts, click on the like button. It just helps. All right. Okay, everybody, I'm going to let you go. Go enjoy the rest of our educational webcast through the rest of the day. I will see you next Monday for another discussion of trading covered calls and short puts, but I do have other webcasts between now and then. I'd love to see you in those as well. So I'll look for you in a future webcast. I'll also look for you on X. Go fill out that survey. And hey, whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.